Good morning, everyone. My name is Gina, and I'm here today to speak with Ken New from Pinnacle Financial Wealth Management. Ken, how are you?
I'm doing well, Gina. How are you today?
Good. I look forward to these Facebook Lives with you.
Good. I do too.
Yeah, so thanks for taking the time, like always, and joining me on a Facebook Live and just continuing to educate all of us. So I appreciate it.
Glad to be here.
Yeah. So, and thank you everyone for tuning in. Today's topic is using permanent life insurance as an asset class. And sometimes you find yourself searching Google for this. Okay. So typing in, can I use permanent life insurance as an asset class? So can we?
Yeah, so that's a great introduction. So life insurance itself as an asset class is debated.
Uh-huh.
And so, the regular investment world would talk about life insurance as having a specific need. Like, well, you need life insurance if you die.
Right.
And, if you're a family person and you've got young children that need to go to college, you've got a mortgage, there's a need for that death benefit, of course. But for the vast majority of people, there's another way to look at life insurance that is a living value. It has really the uses that we would have for any other kind of asset. And so when you think about life insurance as an asset class, you'd really have to focus on the permanent side of life insurance, meaning that you can get term insurance. And many people may have term insurance because they have a mortgage and some of the reasons that we talked about before. But that is for a finite period of time. It might be for 20 years or 30 years or the length of the mortgage, those kinds of things. Then it goes away. But permanent life insurance is designed really to create cash value. And that's really the focus of, I think, the use of life insurance as an asset class itself. That's the meaning behind that. As an asset class, meaning what can we do with that cash value portion of it? So now what we'll do is we'll begin to look at the two types of insurance that are classified as permanent insurance. One would be whole life, which is the traditional type of life insurance, and the other would be the universal life. And there's two types of universal life. And I would move from the whole life to the universal life when I think about building cash values. And so what happens there then is that we really focus on a couple of types, which is indexed universal life and variable universal life. So those two really comprise the vast majority of the assets that are used to create living values. And that's the key thing to be thinking about, living values, which is cash value. Now, the advantages of putting cash into permanent life insurance is, number one, that life insurance policy is going to stay with you until you die. Okay, in the vast majority of cases, it's the type of life insurance that stays in your portfolio until you die. And then, of course, the death benefit would go to the beneficiaries tax-free. Okay, so that's an estate planning piece to it. And, a lot of insurance sales is done just on that. It's just, you need it. You want to have it when you die. We don't know when you're going to die, so we want to fund it so it's there and it passes on to the next generation. But really the focus today is to talk about, well, what can I do with it while I'm alive? Or what are the benefits and, what are the advantages of that? And so I think that's the part that we can focus on. Does that all make sense so far?
Yeah, absolutely. And so, just so there are abbreviations for index universal life that, I may be talking in point later on this conversation. So index universal life insurance is also known as IUL, correct?
Yes.
Yes. And the variable life insurance is VUL.
That's right.
Perfect. All right. So I feel like it's gaining a lot more popularity also in my age range. I'm not going to say we're in my 30s, but I'm in my 30s. so, and I just feel like it's becoming more of a commodity. Like this topic, people are becoming more aware of life insurance. And like you said, and how you can use it more while living.
Yeah, absolutely. And the living values have significant advantages. And I want to be careful when I begin to have this conversation because we become somewhat closed-minded about life insurance because it just seems like it's something that's sold. And,
Yeah.
and I don't think life insurance should ever be sold, not cash value life insurance. I think it needs to be bought. I think it's the type of an asset that it needs to be explained to the client in such a way that they understand the benefits of using it.
Right.
Now, I'm going to begin by talking about how you build cash value the most efficient way for the average person. I'm not going to get into insurability and things like that because there's always strategies around insurability. I will say this, many people have a misconception, and that is they can buy as much life insurance as they can write a check for. And that's just not the case. There are certain codes of the IRS that limit the amount of money that you can put into a life insurance policy.
Right.
Just like there's a limit to the amount of money you can put into a 401k each year.
Yeah.
It's just the amount you can put into a life insurance policy, we can expand that. Okay, it can be significantly more than is put into a traditional retirement plan asset. And the parallel to it is in the traditional IRA or the retirement plan asset, it's taxed at your tax bracket when you pull the money out. Whereas we can pull money out of permanent life insurance tax free. Okay, we won't pay taxes on it. All right, so that's an advantage. Okay, and that's an advantage that I go over with CPAs, I go over with tax professionals on behalf of my clients to help them to understand how to access that money and how to build it the most efficient way. So let's begin then. Someone who's used to the stock market and used to indexes and used to the whole strategy around how to build an asset and grow it, they're going to be thinking of, oh, I'm averaging 6, 7, 8, 10% rate of return on my asset. Okay, so we're thinking about that. We're realizing, okay, well, that's the typical retiree. That's the typical investor is looking for a return on investment. You really want the same kind of thought process in life insurance. Again, the difference is growing the money tax-free versus tax-deferred. Now, having said that, then, how do we do that? Well, that's the use of an indexed universal life or a variable universal life. All right. Now, I'm just going to expand one more moment on that, and then I'm going to get back to the key things that we want to be concerned about.
Yes.
The one thing that I would expand on is that typically we like to consult with partners who have a lot of integration with major life insurance companies, because not all life insurance policies are created equal. And I can tell you from experience, 26 years now, I have consulted with life insurance companies. And the policies that you take off the shelf, ones that are out there for the consumer, are typically not built the way that you would want them to be built so that you grow the most amount of cash value. So again, this gets a little complicated, but it's really a simple concept. You want to grow the cash inside that policy just like you would any other investment. And I'll give you an example of one of the most effective ways to do that in a universal life. You would use an option called a collar. All right, now there's some folks that may be listening to this and they understand a collar. So they understand that that means you can put a cap and a floor on the cash value or the financial strategy associated with that. And it could be in an index, and typically is. But in the investment world, it would cost a fair amount of money to do a collar. All right, so there's a cost associated with that. And so we can mitigate that inside of a life insurance policy. And we use, again, the averages over time to be able to determine what kinds of rates of return that we're using. So there you have it. Okay, that's an investment strategy that really is just something that we would talk about within the cash value accumulation phase of that insurance policy. That making sense so far?
Yeah, absolutely.
Okay, so then let's take a step back and talk about the choice of the life insurance product and the choice of the life insurance company. These are keys. All right. So if I were back in my John Hancock days, I was with the John Hancock in the 1990s, I would be talking about John Hancock products and that's it.
Yeah.
Okay. And time out. That's not what you want to do. You want to say, this is what I'm trying to accomplish in my financial strategy. What life insurance companies out there have contracts that will accomplish this for me? And how do I access that? And how do I make that happen? And I'm just going to give just a moment of thought on that, just to help out. And that is that most of the time, we're coached by the life insurance industry and specific life insurance salespeople who will say, well, let's take a look at your financial circumstances. And we think that using this formula, you should have $2.5 million of life insurance. Okay. Well, that might be appropriate, but that may not be the most important factor when you're accumulating cash inside of a life insurance policy. And here's why. You want the most amount of life insurance when in your life cycle? Well, it's when you die.
Right.
All right. Now, think about this for a moment. In order for you to be approved for life insurance, like a big policy like $2.5 million, you have to be pretty insurable, right? The life insurance company is going to go through all kinds of medical information. They're going to go through lifestyle. If you're a pilot, they're going to get an aviation. They're going to get all this information about you. And then they're going to determine whether or not they want to take the risk. Okay, so they're going to price your costs associated with that life insurance policy. Well, what are the likelihood of you dying in the first few years after getting approved for a policy like that? Very little.
Very little.
Very little. All right. Now, I say that because an accumulation policy should start out with the least amount of life insurance. In other words, we want to pay for the least amount of life insurance for the most amount of cash value. That's the concept. That's how you start. And then what happens is that cash value starts to grow. Then what happens is that life insurance death benefit grows along with it. And guess what? You've accomplished paid up additional life insurance without the cost of life insurance. Okay, that's just the way they're built. All right, so that's a tip for a consumer thinking about cash value accumulation in a life insurance policy. All right, so those
very
are
good tip to give.
Yeah, two very valuable things to be thinking about. The collar, so you have predictable rates of return, and then of course the way that you structure and choose the life insurance company and put yourself in a position to grow that cash value.
So so I know there's direct cash withdrawals versus loans. Can you just elaborate how this all works?
Yeah, so that's the accumulation. At the end of that accumulation, what happens is that you're able to do one of two things. You can either take a withdrawal, and that's the withdrawal of your cost basis. Okay, so the amount of money you put in, you can withdraw back out tax-free. But for most people, I'm sorry, say it again.
You get penalized if you withdraw from your own.
No, not under the structure. Now, if you get into I'll just take a step back. The typical timeline that I would coach someone in funding a life insurance policy is to get that first 7 to 10 years, just fund it.
Okay.
Yeah. Minimum the first 7 years, because that's an IRS code. All right. So that funding mechanism is to put the amount that is appropriate in that first 7 years and let it bake. Okay, let it just mature. Let it do what it does. Now, if someone were to fund a policy, I'll say kind of not be coached properly, and they put a lot of money into it and they find themselves needing to get money out of it in years 2 or 3, bad news. They're going to lose some money in withdrawing, because that's not the use of that type of policy. Okay, so there are consequences like that. Again, that's the type of policy you use. And the company that you're associated with.
Okay.
Now, having said that, then the appropriate thing to do is fund it for a period of time, let's say 15 or 20 years, and then you start to pull money out in retirement. or you simply have to fund college education.
Mm-hmm.
Okay? There's no permission slip. It's your money. You decide when you want to pull it out. You don't have to go to the IRS and say, can I pull it out now? Like in an IRA or 401k right now, we have to be what, 59 and a half? Or we get penalized, right?
Yeah.
Right? So the IRS code will allow for us to pull money out when we want to, but the contract may have some restrictions in those early years. Okay, so we want to fund it responsibly, and then we can take the money out really for any reason. We want to fund a business, we can do it for that. We want to put our kids through college, we can do it for that. Or if we want to structure it as payments over time during a retirement strategy. It's a great way to supplement other income in retirement because we can keep our taxes down, because we don't pay any taxes on pulling the money out of life insurance if we take it out as a withdrawal basis or borrow. And then, of course, borrowing, that we want to do that in such a way that we have what we call a wash loan. So in other words, the cost of the money is the same as the amount of interest that we would pay. So we want to earn and pay the same amount, so it's a zero net.
So what are the benefits?
Well, the huge benefit, of course, is tax-free.
Okay, yeah, absolutely.
And of course, if we structure it properly, in other words, we keep the cost of insurance low on the front end,
Mm-hmm.
and then pay all those front end costs such that once it's continues to build, then the cost of insurance goes down, down, down versus going up, up, up. All right. So if we funded this properly, then we're going to be able to pull the money out anytime we want for any use that we want. We're also going to be able to pull it out tax advantaged, okay, potentially tax free. That's what we're looking to do.
Yeah.
Okay? We're going to pull the money out tax free. And at the end of the day, when we're all done and our life is gone, then we're going to pass on that life insurance policy to the next generation, and they're going to have a death benefit that is going to be tax-free as well. So those are the significant benefits of a life insurance policy.
I just love that it's such a great option for college funding. You know, I have 3 kids, and obviously the cost of college isn't going to go down anytime soon, especially when my young kids are on their way. I don't even want to think about it because it makes me sad. When they're ready to go to college, that's if they decide to do. And it's just such a great option to help fund for college because I feel like it's just going to be unaffordable at that time when they're in college.
Yeah, and I'll give you a parallel to that, Gina. Had a client who said, hey, you know, we got this great cash value. We really don't need it for our retirement right now. And you know what? Daughter is not going to go to college,
Right.
but she wants to buy a house. Can I lend her money to buy a house? Yes. No one says what you can or can't do with the money. You want to give her $100,000 to put down on a house?
Right.
And then, you know, work out your own deal there. Or if you just want to outright gift it to her, the money's available. There's no restriction on what the use is. If she goes to college, you've got that option. If college is not in the picture, but, you know, buying a house, then you know, that's available as well. So flexibility.
Okay, so that is awesome, right? What if like you are paying for college and all of a sudden your child gets, let's say, like a scholarship and to go to college? Is there a way to reverse that, or what happens?
Well, again, the whole idea of taking withdrawals from a life insurance policy is that you're the person who is in control of that. The IRS doesn't control it. You can stop, start. It's you have your own pool of money. And I've always looked at life insurance as being a cash value asset class because of the tax-free association with it. At the same time, of course, the estate planning. Now, when we're in our 40s and 50s, we don't think as much about estate planning. But when you've got that policy that starts out at $1 million and then it grows to $3 million when you're, you know, in your 70s and 80s, well, that is a estate planning strategy that is a byproduct of just the proper structure of the asset class called life insurance.
Right.
Again, my thesis of it is that you start out with the least amount of life insurance and allow for it to grow over time. Now, for someone who does need a large amount of death benefit in the front end of it, then maybe a term rider would be a good idea there. But when we're talking about the combination of life insurance and cash value accumulation, then allow that death benefit to grow over time, because that's the way the IRS code requires it. That life insurance needs to go up, and it's called a corridor. So there's needs to maintain a corridor, okay, or a buffer between the amount of life insurance and the amount of cash value. So as that cash value goes up, that life insurance has to bump up over time. And so becomes the final need, which is, how much life insurance do you need? Well, when you die, you're going to have the largest amount in the policy under this type of strategy versus the large amount when it's least likely that you die, which is the first few years.
So, Ken, is there an age requirement to get life insurance?
Yeah, you just need to be born. Yeah, babies get them. You can put a life insurance policy on your baby.
Amazing.
Yeah, amazing.
It's such a huge benefit for them.
Yeah.
That is great to know. Thank you for sharing that.
Yeah.
That's a huge.
Now,
huge
the flip side of it is, of course, is that as we get older, then it becomes more difficult to get the life insurance, especially the types of policies that we really, that may be most appropriate in this cash value strategy that we're talking about. So, but there's many workarounds with that. There's many ways to structure the life insurance. It's just a matter of becoming aware of life insurance as an asset class and determining how it would fit into your overall financial strategies.
Yeah. So can a cash funded policy be used in a liquidity shortfall scenario?
Well, I tell you something that is misunderstood by a lot of people. Many times, we think about a life insurance policy and the cash value in a life insurance policy as in a way that we can't access it, or in ways that we, there's restrictions associated with it. But the fact remains that you can actually use life insurance as collateral, the cash value in a life insurance policy. And did you know that you can get a higher percentage of life insurance loaned on as cash value than you would in real estate? I mean, as great as real estate is now, if you go to the bank, they're going to loan 90 or 80% typically on it.
Yeah.
Whereas life insurance, you can get up to 100% on life insurance policies. Why is that? Well, because the type of policies that we would coach you to talk about are going to be with companies that are as good as it gets in terms of their credit ratings. They are going to be AAA rated type companies. Okay, they're as good as any AAA bond out there with a golden Fortune 500 company. So again, it is a very valuable asset to be used in a variety of ways. So again, here you can use it as collateral.
So what is the benefit to individuals who have, let's say, like maxed out their tax advantage retirement plans?
Well, I typically will talk to people about maxing out the 401ks to the degree that, if the company's matching it and they're matching it 5% or 10% or whatever it is, get all that money you can. That's cool.
Yeah, for sure.
But above that, we might want to take a moment and think about a simple scenario. And that is that if I put more and more money into my 401k, I'm going to go over more and more time wondering what the tax bracket's going to be when I pull it out.
Yeah.
And we don't know that, but we do know that the governments all around the world want to print more money. And I don't think they're going to stop printing money. And that's inflationary, but it's also got to come from somewhere. Right. And that is in the form of higher taxes, most people believe. So if that's the case, let's lower the amount of money that we've got in tax deferred stuff and increase the amount of money that we've got in tax freeze, like Roth IRAs,
and
cash value life insurance. they may make a lot of sense for the typical investor today.
Yeah, that's honestly, in all seriousness, Ken, I have never looked at it that way that you just explained it. But that's why we have these talks, right? Because
Absolutely. I hope
it
they're
makes
helpful.
sense when somebody else says it.
Yeah, absolutely. These are great tidbits. It's enough information to go to your advisors or do your Google search or do your thinking, give us a call, whatever it is. But it's enough information to realize that there may be something to this.
Yeah.
And if there is, then investigate it, do your due diligence. And if you can find a way to fit it into the plan, then I think that you'll be happy with that.
So, and what should I get? Indexed universal life insurance, which is like the IUL, or the variable universal life insurance, which is also known as the VUL?
Well, that's a great question. And that's the type of answer that you would discover. Mm-hmm. You'll discover that by having the conversations with a professional, beginning at least to understand how life insurance is built. Mm-hmm. I love having these conversations with many engineers here on the Space Coast. Yeah. And so there's a very methodical process they go through to make their final decisions. And it's the same thing here. Take the time to discover and have explained to you the pros and cons of the way the policies work and how to access it, but it should be part of the larger financial plan. In fact, it's critical that it fit into the plan, not be the plan, but fit in as one of the pieces to make your financial plan that much stronger and give you more flexibility, not only now, but in the future.
What are the benefits of an indexed universal life insurance policy versus your typical Roth IRA?
Well, the Roth IRA does have some restrictions. Mm-hmm. Okay, but by and large, they're really going to be two strategies that you can look to work together. Mm-hmm. I wouldn't do one exclusive of the other. I think the Roth IRA is a wonderful product, but you know what? Uncle Sam still owns it. They still have the rule book on it. And the way the law sits right now is that when you pass, then your beneficiaries have to get all the money out in at least 10 years. There's some debate out there that they may accelerate that. Right. So that may not be an advantage then as an estate planning tool. All right. However, with life insurance, you've got that added benefit of a death benefit. Mm-hmm. Okay. So again, they're similar but different. And in that context, when you're thinking about the final answer, which is upon your demise, then how would that benefit the next generation? And so, again, the death benefit is still golden. It's still tax-free, has a lot of benefit there. But the cash value accumulation and the access to cash value is very similar, but different in life insurance with loans versus just withdrawals on the Roth side.
Okay, so there are two takeaways for this whole conversation. Permanent life insurance differs from whole life, and a permanent life insurance policy gives you the opportunity for growth while also protecting your downside, whereas whole life insurance policies are more or less a CD. Second takeaway, find additional ways to save more money for retirement, especially if you've maxed out your tax advantage retirement plans.
Yeah, good takeaways. And that's only the beginning. That's the beginning of how to integrate it into an overall financial plan, for sure.
Yeah. So in conclusion of this whole conversation, get a life insurance policy and use it as an asset class. It's a great idea. And this whole conversation that we had, I personally learned a lot from it. So even though, we do have a life insurance policy, but there are just so many benefits to it that I don't fully understand. And, I know that a majority of people out there don't really know about and haven't taken advantage of, I should say. And especially when there's no age limit of starting policies. it's just, I
Yeah.
think it's a great way to start it young. So,
Yeah, it has a bunch of benefits to it. Each age is going to have different circumstances. Again, the IRS does control how much you can put into it. And so that's where, to be able to talk to someone about the structure of the policy. And going back to a statement that I made earlier, life insurance should be bought and not sold. So you buy it because you know how you want to integrate it into your financial strategies, and fully disclose and understand all aspects of that type of policy, rather than just, oh, we need a death benefit, so this is in case. It's good sleep insurance, no doubt, but that is separate from the overall, what is the financial strategy associated with owning life insurance. So that's really kind of where we were going with it today.
Awesome. Great topic. Great conversation. Very informative. Thank you so much for your time, and just educating all of us. So greatly appreciate it, Ken. It's always a pleasure. And everyone watching, please comment, like, share this informative information with your family and friends. And if you want more information, or if you have any questions, I did attach Ken's his link, his website above. Click on it, reach out, and he's always there to help and answer any questions you may have. As always, Ken, it's been a pleasure. And
yeah, thank you again for bringing me back. I appreciate it. Yeah, I think these are great talks.
Absolutely. Looking forward to our next one.
All right, then.
All right.
Thanks a lot.
Thank you.
All right. Bye for now. Have a good day, everybody.
You too.